Hi, how's it going? My name is Julia and I am taking a stab at translating company operation concepts for people who are thinking about opening their own businesses, aka freelancers or side hustlers, because I am one as well. And what I'd like to talk about today is what the hell is accounting anyways? I've worked in the finance accounting department for companies in New York City for the past 6 years. In my first job, I was managing a tiny part of a big P&L for a corporation. And in my second job, I was the managing director of finance, where I've kind of built the finance department from the ground up. And I was the only person in the finance department, which means that I was doing the month-end close. I was managing all the finances, the budgeting, the forecasting, the P&L, the financial statements, and I've worked a lot with accounting. So the first thing that I'd like to debunk is a person does not need to be a CPA to manage a company's books. So you don't need to either be a CPA or hire a CPA for your small venture, for your small startup or company if you don't have the resources. I used to think that I needed to be a CPA to manage accounting, to manage a company's books, and that is just not true. So many small businesses, especially sole proprietorships, LLCs, partnerships, the owner of the company, which it might be your case, is managing the company's books. When is a CPA required? So every public company is required by the Security Exchange Commissions, the SEC, to have a CPA approving the audits. And when you need audited or reviewed financial statements, only a CPA is allowed to provide an opinion on the accuracy of the financial statements. So when you need audits, and if you are a public company, you need to have a CPA on your staff. Besides that, you are allowed, it's legal for you to manage your own company's books. And this is why we are having this conversation today, because I believe that if you're starting a business right now, if you're starting a side gig, it's very important as a company owner that you understand the basics of accounting, because you just need to understand your financials and your numbers and see if this business is working or not, right? And actually, personal story, the only reason why I went and studied finance and accounting and got my first job in finance is because I've always wanted to have my own business. And in my mind, I needed to have the understanding of accounting and how to read financial statements for my own business. I wanted to be able to look at a P&L, a profit and loss statement for my own business, and understand how to manage and how to make informed decisions. And this is what I wish for you as well, for you to have a basic understanding of accounting so you can either manage your own books or manage the person who's managing your books well. So there's three main things that I'd like for you to know by the end of this video. The first one is that accounting is a process of recording, summarizing, and reporting financial information. So then you, as a business owner, can make informed financial decisions for your business. So it's pretty much a summary, and the purpose is to help business and individuals, business owners, to make informed financial decisions. Pretty much tracking money in and money out, as well as what the business owes and what the business owns. The second one is that there are 5 main categories, 5 main buckets that you will allocate this financial information. Those 5 categories are assets, and assets is what a company owns. So inventory, buildings, equipment, cash, whatever you have in your bank account, these are your assets. Liabilities, this is what you owe other people. So loans, accounts payables, your credit card statement because you're borrowing from your bank. Those are all liabilities of your business. Owner's equity, it's the claim that the owner, meaning you and me, have on the assets of the company after all the liabilities are settled. So for example, imagine that your asset here is cash. You have cash that as the owner of the company, you have a claim. Ultimately, especially if it's a sole proprietorship, that's your cash. But you only have the claim of that asset after all the liabilities liabilities, imagine if you have a credit card bill after the liability settled. So if the only two accounts that you'd have in your financial reporting is bank cash and credit card statement, you'd have to pay the credit card statement to then have a claim on those assets. And then we have revenue, which is the income that is coming in your business, whatever you're selling, services or goods. And you have expenses, which are the costs to run this business. It could be salaries, it could be the cost of producing your good, it could be software, it could could be media buying, ads that you put into advertising your business. Those are expenses. So the term accounting comes from the verb to account, which means to keep a record of or give an explanation for something. The word has its roots from the word in Latin computare, meaning to count or calculation, which funny enough is the same root that the word computer comes from. In the medieval times, so let's think about lands and lords, accountants were the people responsible for rendering an account, meaning giving a detailed explanation for a business owner or a lord about how the business was doing, how resources were being managed and spent. So it's pretty much what still happens today. Accountants are responsible for providing financial information and analyzing, summarizing a business financial information, and they usually present that information to the owner of the business, to a controller, and goes up the chain of command. Back then, accounting was done in a single entry system, meaning that each transaction would affect only one account, one of the 5 categories that we saw before. The issue with that is that single entry accounting doesn't connect the entries. It doesn't connect the revenue that is coming with each expense, and it also doesn't provide a full picture of the business. It doesn't provide all the assets and the liabilities and what is the owner's equity. Is just not as robust. And that methodology was okay for a while. So in the medieval times, you would go to a square and you would be selling your services and goods. Someone would buy something from you. You would book in one line item revenue, and you would go buy something from someone else and you would pay and you would book in your own business accounting cost, and in a single bucket, in a single category. That worked for a while. However, when businesses became more elaborate, when the Renaissance came, especially around Europe and in Italy, businesses needed a more robust accounting methodology. And an Italian mathematician called Luca Pacioli, he formalized the double entry bookkeeping system, which is what we use nowadays. If you studied accounting in any class, or if you read about accounting, you probably already heard this term double entry bookkeeping system. That means that every account has to touch 2 or more of those 5 categories. You couldn't book an entry transaction in only one of those categories. You'd have to choose 2 or more. And the way that this would work is with debits and credits. Debit being on the left side and credit being on the right side. Luca's work laid the groundwork for the famous accounting equation: assets equals liabilities plus shareholders' equity. And I know, hold on. I know that you're thinking, this is getting too complicated. I don't want to know about debits and credits. I don't want to know about the accounting equation. Trust me, I know, and I promise you, you won't have to memorize this, and you won't have to really know the ins and outs of debits and credits and which accounts increase, which accounts decrease, because with an accounting software, and I've talked about QuickBooks before, and there are so many more accounting softwares out there, the system helps you not to make a mistake. The system helps you to navigate those dynamics, but again, as the business owner, you need to understand the concept of it. And I kind of like history, so I'm telling a little story behind it, and we will go over more in depth how this works. But for now, just stay here with me and hear me out. So the reason why merchants started using the system and why it's the system that we use to this day, it's because it creates a natural check against errors. The equation needs to match. Both sides need to match, debits and credits. So the amount of errors that you could have in your bookkeeping system, your accounting system, diminishes dramatically. It also creates a complete financial picture. The double entry provides a full view of the financial position of the business. It tracks not only the inflows and outflows of cash, the revenue and the costs, but it also tracks the assets, the liabilities, and the shareholders' equity. This was crucial at that time of the Renaissance where businesses were expanding, because it also provides more transparency in the business. Before, you would have a list of revenue and a list of costs, and you wouldn't know how those revenues and costs were interrelated. If you needed a cost to produce the revenue, if you sold this and the cost was related to a different transaction, now with a double entry, you would have the type of the account, the debit and the credit to balance, and you would have this transparency around which transactions connect with what. And especially in the times where businesses were being sold and partnerships and big companies were coming up, it helped merchants to manage credit more efficiently, and it was clear how much who owned who, and it was clear how much was owned and by whom. So if you loaned something, if you had a debt with someone else, it was just much easier to organize that. So as I said, we have two sides of the equation. We have debits and we have the credits, and we have the type of account. The type of account is one of those 5 categories that we saw before. A debit is an entry made on the left side of the account, and debits usually represent an increase in assets and an increase in expenses, but a decrease in liability, equity, and revenue. While a credit is an entry made on the right side of our table, and it usually represents an increase in liabilities, equity, and revenue, and a decrease in expenses and assets. Honestly, this is confusing as hell, because in nowadays society, it's common for us to associate debits with any deduction and credits with an increase, because when money is being withdrawn from your credit card, you debited that amount. It's a deduction. You buy something with a debit card, that amount is immediately taken from your account. You have a penalty and they debited the points from your account. It's usually associated with a deduction. Credits, on the other hand, are kind of in a twisted way associated with an increase, because when you buy something with a credit card, even though you're borrowing from someone else, the bank, to pay for that expense, and it's this positive feeling that you have this line of credit to buy something. You can hear the refund was credited to your account. It almost feels like it's given back. You receive money even though you already paid for something if you're receiving a credit. And you can go to a store and they say, oh, you have a credit here. Come back later, you have a credit with me. It just feels like you have an additional money. And at least myself, I associate credits with a positive feeling. However, in accounting, either debit or credit could increase or decrease an account depending on the category, depending on the type of account. And I actually looked this up because that was just intriguing to me. And I was trying to make more sense why Luca chose those words for the table, right? There's different theories out there. The most common that I found, and what made sense to me, is that the word debit comes from the Latin word debere, which means to owe or to have a debt. So the idea here is that when you debit an asset, it would represent that the company has a debt to owe something to the owner of the company, because as we saw in the accounting equation, an owner's equity equals the assets minus the liabilities. So if you have an asset, at the end of the day, that's the owner's claim on that asset. Also, when you have an expense, you increase what you owe. You have a debt to other people. You pay someone else or a different business to have that expense on your accounting financials. And that kind of makes sense to me. The same way credits comes from the Latin word credere, which means to trust or to believe. So if you look at this, you have a credit, you increase the liability. That means that an external party, a vendor, a credit card company trusted you to repay that debt. When you have an increase in equity, the owner of the company, when put money in the business, trusted a business to give that money back, to manage well and give returns. And with income, that means that the customers trusted the business and believe in the value of the service of the goods. Don't know if that's really true. That's what I found online, and it kind of makes sense to me. It helps me get out of that mindset that debit is always something that decreases and credit is always something that will increase. What you need to take from this explanation is that both debits and credits can either increase or decrease an account, depending on the transaction. Those transactions, the debits, the credits, they serve to record financial information, and they will form financial reports that you will see in a different video. They serve to summarize and report the financial statement so you as a business owner can make informed decisions about your business. So the 3 things that you need to know after watching this are: accounting is a process of recording, summarizing, and reporting financial statements so then you as a business owner can make informed business decisions. There are 5 main categories, which we call accounts: assets, liabilities, owner's equity, revenue, and expenses. And that accounting is a double entry bookkeeping system. And for every transaction that you record, there is one side that increase and one side that decrease. There's a debit and there's a credit, and they will match at the end, making sure that your records are correct, that they balance at the end. This is all that you need to know for now, and we'll continue from here. See you next time.